and we can get rolling. As soon as this thing, there we go. You are recording. Great. Okay. It is my great pleasure to welcome Dr. Zac Taylor to the Geographies of Risk Special Seminar Series. Dr. Taylor has been, well, just wrapped up basically a Marie Curie fellowship that we're conducting at KU Leuven, and we started corresponding after, I think, well, we started corresponding on Twitter, but it was after a piece, a kind of wider audience piece that you had written about real estate risk in South Florida that really caught my attention, and so that has turned into a continuing correspondence that I'm very grateful for, and here you are. So today you're going to talk about this concept of riskscapes and reinsurance and I guess and beyond, but this is a continuation or a version extension of this great discussion. You gave us access to all sorts of wonderful ideas in the podcast episode that we recorded as well. So thank you for joining us for this, and we're looking forward to it.
All right, thank you. Let me get my presentation going. All right, does that look good?
All good.
All right, well, thank you. So today's talk is going to be based on a series of papers and essays that have come out over the last year or so, but in particular, a piece in Environment and Planning A from 2020 called The Real Estate Risk Fix. And I opened that up a little bit in terms of how I think about this. But I want to start with how I came onto this journey of thinking about insurance and real estate. I was interested in how, on the one hand, Florida, the place I'm from, how in the aftermath of the global financial crisis, which was really a housing crisis turned financial crisis, how Florida was recovering, how you saw landscapes like this, partially built housing, subdivisions abandoned, the scenes from movies like The Big Short, etched into our memory, but very much alive, a sort of still simmering crisis, a slow and rough recovery in Florida. And we saw these scenes on one hand, and then on the other hand, we saw other scenes like this. We saw hyper-intensified coastal development, particularly in Tampa, Miami. In Miami alone, between 2016 and 2018, I did an analysis. I found over 90 high-rises under construction or recently completed. We're talking thousands upon thousands of luxury developments along the coast. And I wanted to understand how it was that in this kind of space between a housing finance crisis and the emergence of sea level rise and climate risk as a topic of discussion in cities in Florida, how it was that real estate markets were recovering, how it was that they could be growing again so voraciously against the prospect of climate risk. So what was it that was fueling? How do we make sense of this kind of the reproduction of risky real estate markets in Florida, this new dimension of risk? I ended up having conversations with planners. I'm a planner by training, with elected officials, with real estate developers in Florida, and everyone told me the same answer. They told me that I needed to understand insurance, and more particularly, I needed to understand reinsurance. That's insurance for insurance companies. So this senior executive for an engineering firm based in Florida, a very large one, tells me, so far there hasn't been much discussion about the real players in this being the resilience conversation, the reinsurance industry. Right now, there doesn't seem to be any blowback on development in coastal areas. Eventually, you can have all the politics and all the plans you want, but this private sector will eventually have to come to the table. If they come to the marketplace too quickly, they'll destroy value in the market, which is not the value of a resilience program. So I wanted to unpack this. I wanted to understand what he was getting at here. Everyone would point to insurance, but very few people could explain to me how it worked, or what was so problematic, what was so important. How did we understand the power of this market? So in brief, in Florida, but also across the US, what you could call the real estate finance system that really drives the US economy and the economy of other places too, like the UK, property insurance sort of plays a really important infrastructural role in the financial system. And the closest and most important link is with the mortgage lending system. So if you get a mortgage in the US, you have to maintain property insurance. And that structural link is really important because that means that the multi-trillion-dollar mortgage market has to be insured, right? So you have this structural link that's really important. And of course, mortgage lending kind of does two really important things in the economy. On the one hand, it feeds our financial system. Finance is now, last I checked, over 40% of the US GDP is driven by finance. And things like mortgage securitization and related forms of mortgage finance amount to trillions of dollars of financial activity. It's a very important source of economic activity. And that's why it was so central to the last financial crisis. At the same time, of course, mortgage lending is about housing, right? And it's about enabling people to buy and sell housing. And there are a couple of important dimensions to this. Starting at the bottom, over the recent decades, we've seen home equity and debt related to housing become increasingly important in terms of how we generate wealth and economic activity in the US. Consumer spending is closely tied to housing equity and debt. It's really an engine of economic activity. We also see it in terms of real estate linked employment and as a kind of broader industry. It's not uncommon for a quarter of the economic activity of an urban region to be, connected to building and financing development, let alone all of the sort of spillovers. And then we have also the design of the local state in the US being really closely tied to property values. In places like Florida, there is no income tax, which means that local governments almost entirely finance their services that they deliver through property markets. And property values determine that fiscal capacity. And of course, housing finance is key to maintaining those housing values, to maintaining a liquid housing market. So we have insurance as sort of this linchpin underpinning this whole thing. So at the same time, we saw discourses like this from the insurance commissioner at the time in Florida, which is, it turns out, a very powerful position. And he says, we're in a position that we've never been seen before in Bermuda, in London, across the world in terms of investment opportunities. Huge changes are taking place in Bermuda that are transforming the pricing and transforming how we do business. Insurance-linked securities have dramatically changed the Florida marketplace, and we believe will benefit our domestic market. So here he is talking about the state of the insurance market in Florida, and he and others keep pointing to something called insurance-linked securities as something that is really paving the way to a really dynamic insurance market. And this is something really curious and interesting. So ILS, as they're called for short, refers to this broader universe of financial instruments that are used to bring investment capital, like from a pension fund, into the insurance system. Here is the most common type of instrument. It's called a catastrophe bond. I'm not going to go into how it works, but basically you take, on the one hand, capital from an investor, and you use that to provide a form of insurance protection for an insurance firm. So if that insurance company has a really tough year, big losses, say a hurricane hits Miami, they can draw on this investor-provided protection to help pay claims to policyholders. Now, of course, that's not likely. So what really happens most of the time is that policyholders pay a portion of their premiums through their insurer onto investors through this transaction, right? So you get this sort of two-way flow of capital. Now, ILS has been talked about a little bit before from a geographical perspective. It's a relatively recent financial innovation. It's not so unlike other forms of asset-based finance, like mortgage-linked securitization. So if you kind of know what that is, you sort of know what this is, except instead of trading a mortgage payment, you're trading an insurance premium. Lee Johnson, a geographer, has characterized the rise of ILS as a sort of Harveyan catastrophic fix for what she sees as a crisis of overaccumulation. So what she means is that, ILS markets provide capital to capital-hungry insurers writing risks in hurricane-prone Florida and places like that. But at the same time, they are increasingly looking for a place to park their capital. They're finding declining opportunities for investment. That's the crisis of overaccumulation. And what she's theorizing here is that instead of just satisfying demand from insurers for protection capital, what's actually going on here is that capital is flooding the insurance industry looking for an investment outlet. And she goes on to hypothesize that this might create a crisis that is displaced, in her words, to the built environment. So if there's all of this protection capital entering the market in places like Florida, insurance rates might be lower than they would normally. This would allow building to continue in risky places that maybe it wouldn't otherwise happen. And eventually down the line, that could create some problems if that capital disappears, or if there's a big disaster, or climate risk just sort of erodes the market. And it's a really compelling thesis, but there are a couple of limits with it, and that ended up being a point of departure for me. So Lee doesn't consider the role of Florida in the making of ILS markets. And this is really interesting because, to go back to the insurance commissioner's comment, it turns out that between half and 2/3 of all catastrophe bonds, the most common type of ILS, are invested in Florida. And Lee doesn't really think about how it is that specific forms or patterns of urbanization might give rise to this fix. So, what if it's not just a crisis of capital that we need to be thinking about, but a crisis of urbanization? And what if it's both of those things happening at the same time, right? What if the opportunity and the demand for ILS is not just because capital is looking for a place to go, but because places like Florida, by virtue of how they've grown in relationship to risk and how they finance real estate through the links between insurance and mortgage markets and beyond, what if that's the crisis that's attracting the capital? What if we need to think about those things together? So I want to, for the next part of the paper, locate ILS, its origins, its evolution in Florida. And I want to do so by thinking about 4 interlocking crises, one of exposure, calculation, capital, and returns. And these different crises and their relationships with each other, I argue, can help us understand how and why ILS has emerged in relationship to Florida as a real estate risk fix, and what that might mean about in terms of the relationships between real estate, climate risk, and finance, and beyond. So to understand the story, we got to go back in time about 3 decades to Hurricane Andrew's landfall south of Miami. It was a really destructive storm, a Category 5 hurricane, which is the highest in terms of its strength and intensity. It triggered a significant loss of life, damaged or destroyed tens of thousands of properties, and at the time was the most costliest disaster in US history. And it triggered what we can think about as a dual crisis of exposure. And the first was for insurers. Both Florida insurers, the ones that sell the policies to ordinary folks, and their reinsurers had really failed to take into account their exposure to hurricane risk in Florida. So insurers struggled to pay claims, several were declared insolvent, catastrophe reinsurance rates skyrocketed as capital was just completely used up. And the remaining firms in Florida sought to really roll back their underwriting, so to offer less policies and to raise their rates to make up for losses. When I talk about raising rates, I'm talking about, premiums going up by 200%, deductibles by 500%. Numbers like that year over year were not uncommon. And so perhaps this might not surprise you, but it was also signaled a crisis of exposure for Florida's real estate sector, right? And overnight, basically, insurance became one of the greatest costs of owning a property in Florida. And that really threatened Florida's home values and real estate driven economy. Think back to that diagram I showed you a moment ago that laid out those relationships between insurance and the real estate system. And everything I said there holds true in Florida, but is even more central and important because Florida's economy has an even greater dependence on the real estate sector for employment. As I mentioned, Florida doesn't have income tax, so it really relies on property markets to provide government services. So this was a really significant vulnerability to that, what we could call growth machine. So Florida state leaders recognized that they had to do something. And so they undertook a series of interventions in the market to try to stabilize insurance rates. And this plays out over a couple of years and a couple of more hurricanes. But basically what you need to know is by the end of it, the state is going to have a primary insurer selling policies to consumers. They're going to have a reinsurer selling hurricane reinsurance to insurers. They're going to have a guarantor that promises to pay claims if an insurance company goes out of business. And they're going to have all sorts of other really important market shaping mechanisms in place so that they can really try to stabilize Florida's real estate system. And this ends up being important. Now, almost at the same time, we see a crisis of calculation. So after Andrew, insurers searched for a new way to try to evaluate their exposure to catastrophe risk. Traditional actuarial practices relied on historic loss records, and those had really failed to account for how fast, places like Florida were growing. The industry had really sort of systematically undervalued its exposure to, a peak peril, as they call it, Andrew-sized loss. And so after Andrew and some other disasters, including the Northridge earthquake in LA, they settled on a new technique that was forward-looking, called the Stochastic catastrophe risk model. And these became widely adopted as the kind of new basis of actuarial practice in the industry. So really briefly, this gives you an idea of what these models look like. They combine a series of information about hazards, events and their intensity, data, geophysical data on things like elevation. They also integrate information about buildings, their construction standard, and so forth. And they then begin to estimate how hypothetical events, thousands of events, simulated across that portfolio of exposed assets, how they perform financially, what are the possible range of damages. And they evaluate that at a firm level, at an insurer level, against the terms of a policy. And that helps insurance companies determine what kind of spectrum of possibilities they face in terms of insured losses. And that enables them to make all sorts of financial decisions about how to manage the risk. Maybe they write fewer policies in certain places. Maybe they try to charge more money for those policies. Maybe they save more money, save more of the policy premiums they earn. They have a bigger, rainy day fund. Maybe they buy more reinsurance. And so to that end, models have really opened up new ways to objectify and govern a kind of wide range of catastrophe risks. And that includes what I just spoke about, which is sort of how this changed actuarial practice within the sector, but it also connected insurance actuarial practice to capital markets and regulators in a new way. Right. This, I think, really unlocked a new paradigm of sort of sound risk management. Investors could suddenly understand hurricane catastrophe risk as a sort of as a market object, something that could be traded, right? We could measure the probability of a certain loss event happening to a firm. We could then assign a price to the value of protection that could be traded in semi-liquid form, like an asset. It also helped regulators to understand the possibilities of something like Andrew happening again, and to agree on new ways to capitalize the sector. So, now a regulator might have a new understanding of what was possible, and, as in the Florida case, would really encourage firms to secure adequate reinsurance protection against that kind of prospect. So there's a lot of debates that happen in the aftermath of Andrew about what those solvency requirements should be, how much capital insurers should have, how to price it, how to trade it, and so forth. And risk models are really at the heart of this. And Andrew also got folks thinking about in the sector about some of the structural limits within the sector in terms of capitalizing catastrophe risk. One insurance investor explained to me one time that there's a sort of geographical imbalance in the insurance industry. 80% of the risk is in 20% of the locations, but the insurance industry is designed to spread risk horizontally. And this sort of vertical horizontal imbalance meant that historically, insurance companies could only spread the risk so far. At some point, they were no longer able to disaggregate that sort of peak peril risk. And that's the kind of risk that creates Andrew-like financial disasters. So the debate began to turn towards the question of how can we bring in new capital into the sector that transcends traditional reinsurers to take some of that risk. And so we see the rise of different experiments in the 1990s that try to do this kind of work before ultimately settling on catastrophe bonds, and later after that, other forms of ILS begin to emerge that solve different types of financial problems in the sector. So over time, lots of things happen that enable the rise of catastrophe bonds and ILS. New types of investment funds, types of insurance instruments, they all emerge. They're increasingly pitched to investors as something that provides an alternative beta. For those of you who are not financial geographers, this means that catastrophe losses are, at least in theory, not correlated with the economy. So investing in hurricane risk in a place like Florida or wildfire risk in California provides a way for a Dutch pension fund, hypothetically, to diversify their portfolio, to balance it and to make it more resilient against economic downturns. And so you get a whole universe of firms and brokers and expertise that builds around this idea. You also see the emergence of offshore geographies designed to facilitate ILS trading, mostly Bermuda, but also places like Singapore, the Cayman Islands, Hong Kong, places which have the institutional, regulatory, and tax infrastructure to allow investors from country A to provide capital to insure risks in country B. And a key point here is that these geographies have to make it cost effective and profitable to do this kind of investment. So you see in most of these places that they are tax-free. And they entail relatively limited regulatory scrutiny compared to trying to do it, say, in New York or in London. So despite all of these efforts, the flow of capital into this sector remains pretty modest until a series of big hurricanes hit the US in 2004 and 2005. In 2005, of course, we see Hurricane Katrina, but there were also several storms that made landfall in Florida. This caused reinsurance capacity to be depleted, and it caused rates to spike. It's a supply and demand situation where all of a sudden insurers and reinsurers need a new source of capital, and the cost of that capital grows up greatly. And that really attracted investors at the time. A few years onward, we get the global financial crisis and a macroeconomic situation where there's a lot of capital out there looking for a place to go, for collateral to attach itself to. And that's what Lee Johnson was getting at with this idea of a crisis of overaccumulation. And it's really at this time, beginning in the aftermath of Katrina, that the scope of ILS, really expands. So, we go from roughly $9 billion to almost $40 billion of outstanding issuance in the sector. And that's a growth rate that outpaced the rest of the sector by nearly 7-fold. So while ILS appeared to resolve this initial capital crisis, this outsized influx of capital sparked a crisis of returns. And this is the last of our 4 crises for reinsurers. So because all of this capital is flowing in, it becomes much harder to charge the reinsurance rates needed for the sector to be profitable. So over that same period, we see global reinsurance rates decline, and in the US by almost 50%. So as insurance companies and reinsurers offer what are called renewals, they try to sign up their new annual or 1 or 2 or 3 year contracts, they get into what one executive in the field called a knife fight. There are mergers and acquisitions and partnerships, investments in insurance tech and all sorts of platforms, all of which are designed to try to secure ever-thinning returns in the context of this influx of capital. So this is where Florida comes back into the picture again. As returns deteriorate, investors in ILS and reinsurers look to the Florida to source new risk, troves of which remain trapped in the state's portfolio of insurers. And in order to understand this, you need to recognize that after Andrew, there was a gradual shift from large national insurers writing policies in the state to specialist insurers, as they're called, and the state's own insurance company, Citizens. The specialists are called specialists because, as you might imagine, all or most of their business is focused in Florida homeowners insurance. And this is really unconventional in the industry, at least in terms of the amount of the market that is written by these types of firms. Maybe other insurance markets have specialist firms like this, but the extent to which 25, 30, 40, 50% of the Florida market is written by this type of insurer is a little bit unusual. And what's interesting about these firms, especially Citizens, is that they hold the risk that has historically been the most difficult to marketize. In this context, you have a bunch of historically difficult, troublesome risk stuck on the books of these insurance companies, and it represents an opportunity to go to them and say, look, I've got capital, I can help you expand the amount of reinsurance protection you have, and in doing so, I as an insurer or an investor can source more risk and therefore source more revenue. So to understand how this works in practice, one of the things I've done is a forensic analysis of the specialist insurers and their reinsurers. So I looked at the financial records for 28 of the specialists in 2015, and I found that they spent 50 cents of every dollar they collected from policyholders, about $3 billion in total, on reinsurance. So immediately, half of every dollar goes to pay for extra catastrophe insurance protection. That cover came from 164 distinct reinsurers in 36 jurisdictions, to use an insurance industry term. So that means like Bermuda, it could mean New York, it could mean the UK, it could mean Hong Kong, really all over the world. Now, it's really tough to track this stuff. A lot of it happens off of the kind of financial records that are publicly available, but at least $529 million of this premium goes to known ILS funds or platforms. So this is definitely a conservative estimate, but if you assume the kind of going rate for catastrophe insurance at that time, that buys you $8 to $10 billion of coverage. Maybe, you know, up to about a third of all of the ILS outstanding that year. So what I'm getting at here is, you know, we can really trace back this ILS, this global market, down to a couple of firms in places like Florida, which really rely on access to investor capital to procure catastrophe insurance. This isn't just a story of firms and market changes over time. The state of Florida has played a really important role in making this possible. They are a big issuer of catastrophe bonds. The Citizens itself set the record going to the market. It's issued the largest bonds. They also indirectly made this possible by moving risk from Citizens to the specialists. That's how I came up with this group of firms to look at. All of the private firms involved in this sample of those private specialist firms took policies from Citizens in exchange for subsidies. Over that period, hundreds of billions of dollars of insured residential risk moved from Citizens to specialists, and then from the specialists to reinsurers. More recently, the state is now also using retirement funds to invest in ILS. So they are issuing the funds, they are investing them, and some of their traditional roles as, for example, a guarantor also exists. So the state of Florida plays a really important role in leveraging its financial and regulatory powers to make this market possible. Of course, there are a lot of interesting connections between specialist firms and global reinsurance markers. If you look at do corporate analysis, for example, you see that 15 of the specialists were created or entirely restructured explicitly to take on risk from Citizens, to marketize that very troublesome residential risk. Also see really extensive executive level and board level connections between the specialist firms and reinsurers. In many cases, or in some cases, direct investment or ownership connections. And you also see several ex-Florida insurance officials appear as executives or board members of these firms. So it really is a case of, you know, a close connection between the state and between global capital, making possible this kind of institutional bridge. We also see, you know, new underwriting strategies take place in the context of the specialists. An example is fronting, where specialists cede every premium dollar they earn to reinsurers in exchange for a commission. And what that means is that, you know, instead of a conventional insurance business model where you know, you write a policy, you hold a little bit of the risk, and you reinsure some of that risk. In this case, you know, we increasingly see examples of residential insurers which are just a pipeline. They just provide risk to investors. So in this context, a growing volume of Florida premiums flow offshore for securitization and other forms of financial engineering that in ways which really recall the originate to securitize model of the mortgage crisis. This is what Lee Johnson has called an underwrite to securitize regime. If you're looking at this from an insurance industry perspective, they might contend that this capitalizes Florida's insurance sector. It makes insurers more resilient. It externalizes that high catastrophe exposure, and that this is the cost of doing so. It also, you know, it also reflects Florida's structural dependence on insurance. It shows how that is exploited to feed risk into capital markets, right? Those investors increasingly demand investable capacity, right? And so even within industry discourses, there's a recognition that this is, you know, a movement that is in part driven by the need for protection for places like Florida, but also other catastrophe-prone insurance markets. But it's also about providing capacity for investors. So how do we think about this? You know, Lee Johnson, when she was talking about the catastrophic fix, was riffing on David Harvey's seminal concept of the spatial fix. And that's really fix one here. So ILS transforms that relationship between risk and capital. You know, it marketizes billions of dollars of hurricane catastrophe risk enmeshed in residential real estate. It does so by steering capital to insurers, but also trying to feed investor demand for capacity, right? And that is, in many ways, that is an example of, I think, a good example of the spatial fix, and I'm happy to elaborate on that if folks are not familiar with it. But it also, I think it reflects a second fix. It's a fix for the spatial fix. You know, ILS, reinsurance, it shows how the real estate finance system's dependence on insurance can kind of be momentarily secured, protected. And it allows, I would argue, risky real estate driven political economies like in Florida, but really in many, many other places to continue to chug along despite growing risk, right? So it's a fix for the spatial fix. Now, of course, there's a lot to say about this, this fix, beginning with the limits of it within Florida. You know, it is a form of financing that is closely connected to a very particular geography of housing, to owner-occupied, mortgaged, residential housing. Insurance markets don't protect people who are renters in Florida. And I think that this geographical particularism is really, really important to understand, because that shows where there might be potential problems with this fix on the horizon. I think the most important kind of emerging problem is affordability, and I'll talk about that in a second. We also need to think about how other fixes might appear in other places. So I've been doing research beyond Florida in the Netherlands and Singapore over the past few years, and we see very different articulations of risk and risk management in different property market contexts. You know, in Singapore, you see much more of a state and infrastructure-driven strategy, whereas in Florida, we see a system that definitely involves the state, but relies on private property finance to manage risk. We also see beyond places, different types of risk fixes emerging inside institutions, the institutions that comprise the real estate finance system. So beyond looking at insurance, I've also been looking at how institutional real estate investors are understanding their climate risk and adjusting their underwriting strategies, their investment, acquisition, retrofitting, and divestment strategies around climate risk. And there's a lot to say about that, perhaps again for the Q&A, but what we see are different ways of contending with and financing climate risk emerging. And the ways in which these institutional and place-based forms of real estate climate risk management play out are going to be variegated, and the pathways and the futures are going to be, you know, equally complicated along those lines. But I think it's an important way of thinking about this, the fix as a concept. So to leave us, I'm conscious of time, I want to just pose three kind of general questions about this fix, but any kind of real estate risk fix in general. There is, I think, on the one hand, this tension between affordability and profitability that is a recurring issue when we try to financialize climate risk. Florida really shows over this history how, on the one hand, the need to maintain affordable insurance rates to maintain the real estate sector can come into conflict with the profit motives of insurers. And these days, I think the balance with ILS is somewhat tilted in the favor of the capital providers rather than homeowners. But there are contradictions here on the horizon. You know, in the context where insurance costs can be many thousands of dollars per year for a homeowner, the prospect that those rates continue to increase year over year as climate risk is generally understood to increase means that, we get a contradiction here, where insurance as a mechanism which is, meant to protect property and property value actually leads to the devaluation of that property, right? Because that expense is so great. And the question is, in places like Florida, where does that housing crisis happen? And we can begin to look for clues of that, where we find mortgaged homeowners struggling to pay their housing payments and in high-risk areas. And there, I contend, we might see patterns of housing crisis in the future, potentially new forms of displacement, foreclosure, and so forth. The next question is one about capital durability. For Harvey, this idea of the spatial fix has always been one that is concerned with the fragility, the kind of temporal dynamics of capital moving in and out of the built environment. And there are definitely signs that insurance capital is, this kind of insurance capital is not necessarily long-term. After hurricanes Harvey, Irma, and Maria in 2017, we begin to see a few years later the first signs that this is spooked some ILS capital. Unexpected costs, the delays of sort of reconciling accounts after disasters has depleted a lot of the capacity in the sector. And that has had implications in Florida. Some Florida insurers have requested significant rate increases. Others have said that they're going to forego purchasing extra catastrophe reinsurance. Others have said that they want to reduce the number of policies that they write in South Florida by the thousands. And so we see how this market arrangement is quite fragile. It's exposed not only to pressures on the regulatory side, the affordability side in Florida, but also to global conditions. If there are catastrophe losses in Australia and Japan and Europe and California in the same year that there's a Florida hurricane, we can see this kind of global finance system stretched. And its durability, I think, is in question. So even if there isn't necessarily a crisis in Florida, Florida is exposed. Its economic resilience is exposed by virtue of the architecture of this market. And we need to be thinking about the durability of capital flows when we interrogate how risks are financed looking to the future. I think the final question, and the hardest one to get at, is one about whether or not risk finance is extractive or it's transformative. And what I mean here is, I would contend that this risk fix leans towards the extractive side. Of course, the service is being provided, but Floridians pay over $10 billion per year on residential insurance premiums on the promise that they might get repaid in case of a major loss event. Now, when you understand that a bad hurricane hitting South Florida could cause $100 or $200 billion in losses, you understand that there are high costs that have to be paid to finance that kind of risk. But we also know that there are increasing forms of speculation, that insurers and capital providers are, in essence, charging rents to mobilize this capital. And I think this is, again, a bigger conversation, but it sparks questions about the efficiency of this model. And it's whether or not it can be afforded when there's a need to fundamentally mitigate risks. So might a growing portion of that premium go into risk mitigation, for example? Now, it's also important to realize, finally, that this market arrangement connects places in ways which are quite complicated and go beyond just a story of, problematic speculators, trying to make a quick buck against Florida. A lot of the capital that goes into this space, it comes from Canadian retirement funds. It comes from, Dutch pensions. We, ordinary people, are very much complicit in this. And the political economies that we live in are also closely connected with these. A large share of reinsurance activity happens in London. A big piece of London's economy, its contribution to the UK GDP, comes through the reinsurance sector. And so, we need to think about how these markets connect and shape relations within places, but also between them. There's a lot to think about here, and a lot to think about at different scales in terms of how to make this a system of moving resources around the world that can help us to accomplish the goals of transforming places to make them more prepared. I hate to use the word resilient, but more able to cope with the kinds of growing risks that are in front of us. So on that note, I want to stop. So we have 1 or 2 minutes for questions, and would be happy to direct you to other writing on this topic and some others who have written tangential to this.
Thank you so much. The floor is open. If you would like to ask a question, please just throw up your team hand there at the top of the screen. We can pose it. Yes, Daniela.
Oh, hello. It's just one quick question, a kind of controversial one. Once insurance become a business to this type of land that is highly risked by climate, or even because technically in the human occupation of this soil is highly risk, so insurance itself will become a business. So how to reintegrate and mitigate this to be not like profitable, that the climate change of this hurricane season is not something you can profit, but you do it actually for protect?
I mean, I think that's the question, right? Like the question here is, how do we deal with the fundamental problem of the physical risk? And insurance is often talked about as part of a broader suite of risk management strategies. It's an example of risk transfer, but there's also risk mitigation, right? And in theory, these things complement each other. That comes down to building codes. It comes down to land use planning. It comes down to retrofitting. It comes down to rethinking how we've developed and how we're going to equitably atone for the problems of that development. It's not just about limiting future growth, but having parallel conversations about retrofitting, about managed retreat. We have to accept that certain places pose challenges to living reliably, or at least living within the sort of financial or economic parameters we've injected into the built environment, right? Yeah, there might not be a bad Florida hurricane for 20 or 30 years and you can live a comfortable life there. That's the contradiction here, right? I think that this has to be put into that kind of context. Does that make sense? And the thing is, there are all sorts of interesting risk management frameworks that involve insurance out there. The National Flood Insurance Program in the US for all of its faults, Flood Re in the UK. There are examples of different types of insurance strategies that try to blend finance with infrastructure investment, with land use planning. I think things like that they're really important.
Thank you.
Any other questions? Now's your chance. Well, I echo. I think your set of tensions, those last three sort of big open questions, and each of them having their own, each of them a tension, and they're all they're interrelated as well. I think is a very compelling way to organize this. I mean, they're massive questions. So that sort of trio of tensions I find very compelling as a way to think about, just make some order out of these systems that are so exceptionally dynamic. And I do wonder about that kind of, if those tensions tip toward the profitability and extractive side of those relationships. I wonder if there's a point at which sort of the more leveraged those are, the sort of closer catastrophic failure, just on the basis of sort of markets, not even necessarily natural, a natural hazard forcing that event. It can tip. It can sort of. I just wonder about it tipping off in that direction of the market works until it doesn't, and then everybody, and I guess that's in the back of my mind, one of these, because you can see how it could take a very similar shape, and we've talked about this a little bit before. It can take a very similar shape to the way the subprime mortgage crisis was organized, I guess. But I don't know if you see it tipping, or like a sense from the insiders that you speak with. I don't know if you have a sense of that, all of those trends toward profit and extraction over the other sides of the balances that you described.
There's so many dynamics here, and like questions about how to like balance costs and responsibility and profit, and so many actors and dynamics and considerations that are shaping this, and that's where the other paper that we based the podcast on, the Riskscapes paper, tries to draw conceptual attention to how those different things are playing off each other, and to use one small example from Florida of how they play out over time. So the answer is it's really tough, and it depends who you're talking to. At the end of the day, there's a question about whether or not, I think the affordability versus profitability concern, if we were going to reduce them to a kind of key focal point, that would be a good one, because that's the kind of question that's going to play out at a key point in all of this, which is on the regulatory side. And there's going to have to be a kind of reckoning, I think, on the regulatory side with how states organize risk management in general. And I think that's going on, and it's an ongoing conversation. How much can they lean on capital markets to absorb this? How much can they expect people to pay? How do they redistribute the costs of that? I think that's going to be a fulcrum. It already is a fulcrum, but I think it's going to increasingly become the fulcrum that shapes the parameters in which insurers can derive a profit from this kind of business. They might find that they have other ways of shaping it. Insurers and related kind of risk advisory firms are shaping this conversation in so many other ways too. It's not just about underwriting, it's about just helping to value future uncertainties and to shape decision-making processes. So there's a lot of ways for the insurance industry to adapt its business model too. And I think there's a great deal of conversation happening there about what their game plan is, but everybody is sort of walking a tightrope here, right? Yeah. And so again, that's why I come back to the fix as a root metaphor for all of this, because it's something that is fragile, it's provisional, it's temporary, and I think that's what we're seeing here.
Well, I always enjoy what's coming out of your workshop, and I look forward to the next things to emerge. And thank you so much for your time today. And we'll post this video, and it's great to see you in virtual frame. So yeah,
it's a pleasure. As always, thanks everyone, and take care. Bye.